I think this cuts in the later half of 2023 is the main contention point right now because 6% inflation, core inflation is still high. And even our own analysis shows that non-housing core inflation, which the Fed Chair Powell is focused on, it can be sticky. So it's just creating that option value to see how things go before thinking about the cut and the next real pivot. And that's where I think the hawkishness has come through, and it seems and sounds hawkish, but really it's acknowledgement of the fact that the journey has just started rather than ended in a way.
Salman, you and Steve seem to have conversations about cricket, so let's bring in a cricket metaphor here, right? Let's see if the Bond King, Jeffrey Gundlach, who seems to want to have a dill scoop on things here, says that, perhaps the Fed should stop raising rates after the latest hike as the economy is already weakening. Do you think that's perhaps something that should be considered at this stage, or just too early to be stopping this process?
So basically, the labor market is the main situation. So again, using a cricket analogy, in the sense that your batsman is playing quite well right now, and that's why you need to think about what kind of yorker or ball you need to put through to bring inflation down, and that's the labor market, and I think labor market shortages, Powell talked about are, and the structural nature of those means that, you may have to do more damage to the demand side. There's no doubt the housing market is under pressure. There's no doubt that will then start to feed into lower rental prices. In fact, rental leases, as Powell mentioned, are coming down. But it's really the sticky component which is related to the labor market strength, which needs attention. And that's why the focus and the willingness to wait before making that next move towards cutting as the economy moves through this cycle.
Okay, so here's my follow-up delivery then, Salman. We usually say one shot doesn't make the summer, right? And I guess in this case, it really is the case. You've had that inflation print of 7.1%, which does bode well for inflation, but it doesn't necessarily set the tone precisely for where things may go. Are we saying that it really has peaked at this point in time? Is there sufficient confidence in that mark?
So if you look at the tightening which has come through, and of course we know that the headline inflation will come under pressure because of base effects. So at least headline we are more confident on. So that this will start to roll over. On the core side, we know some components will come under pressure because of demand damage, which is already in the pipeline. So there is this confidence, and some parts are going to come under downward pressure as this cycle moves through. But ultimately, it's a test match. This is not a T20 game. And that's what the market is, I think, used to. Seeing quick action, financial liquidity squeezes, and the Fed backs off immediately, and everybody is happy after 3 hours of T20 cricket. But it's really turning into a test match where that you need phases to come through in this play, and inflation to come down gradually, and then the Fed starts to think about the next stage of its cycle.